Hello everyone, welcome to the Road to Retiring channel, and today I want to have a look at Adobe. I was having a look at my metric meters sheet. This is the sheet which has where a stock meets everything I like to see here, and I noticed that Adobe's price had fallen under my buy prices. The current market price, as you can see, is just below 0.28% below my buy price. Let's have a little look into why. So it's down 7% today, which is why it's suddenly below my market price, or my buy price, sorry. And let's have a look at why. So they wanted to complete this acquisition of Figma for around 20 billion they were supposed to be acquiring it for. However, there is now a roadblock in place as the Department of Justice are preparing a lawsuit which could potentially block this acquisition from going through. Now, Adobe is still expecting this to go through, as they go on to say down here. They say we're engaged in constructive and cooperative discussions, and they continue to expect to close the transaction in 2023. So they're still expecting to complete this, but it has made a few investors a little bit cautious. And as you can see, the price of the share has dropped 7% today. I want to go into their fundamentals and look at what price we should be looking to potentially pick this up at, and what the analysts are expecting Adobe growth and long-term outlook to be. So heading over to the sheet, as I said, first thing I like to look at for a company to manage the risk is their moat. How have they been able to perform historically at growing equity, earnings per share, operational cash flow, and revenue? And as you can see, I put in Adobe here, there, which is the same data. Their cash flow, everything is above 10% compound annual growth rate since 2015 across all four of the metrics I like to look at, which is absolutely perfect, and the total average is coming in at 20%. Now, you know, for me, I like to see a 10% or higher compound annual growth rate in all of these, so to see 20% is really impressive. And yeah, I think that shows great ability to grow the company, and that hopefully they'll be able to maintain those competitive advantages they have. Additionally to this, I want to see that the management are dealing with the funds effectively, and their return on invested capital is currently sitting at 25%, which is really nice. As you can see, it's consistently been above that 10% benchmark I like to look at, again at 12.5% being the lowest it's ever been in 2016, in the last years or 7 years, I guess. And you can see, look, even since 2018, it's never been below 20%. So really nicely above that 10% benchmark I like to look for. And finally, I want to see that it's not going to be in any imminent financial trouble. So to do this, I look at the long-term debt and I look at the free cash flow. If the free cash flow is able to pay off the long-term debt they have within 3 years, then I feel comfortable they won't be in that imminent financial trouble. And as you can see, their long-term debt is way below even their free cash flow for 1 year. Their 3 times free cash flow coming in at 22,000 is in millions, so over 5 times larger than what their long-term debt is, 3 times free cash flow. So yeah, really nice to see that. I don't think they'll be in any imminent financial trouble because of that. So I put Adobe into my automated sheet. I wanted to see what the value came out as here. The value's coming out absolutely ridiculously high, an average of 568. So I went into the manual input and updated my values in here, and after changing the values, I've got an average fair value now of 340, which is actually a little bit above the metric meter value I had in 13th of February. So I've gone in here, I maybe was a bit more conservative with estimates then. Currently, I've gone for a 10% earnings growth rate. As you can see, the analyst 5-year expectation is 13.5, but because the realistic growth rate is coming in at 36%, I feel pretty confident that they will be able to get closer to this 5-year estimate, and that they're not being too ambitious with this. So I felt comfortable with 10%, halfway between the 5-year analyst estimate and half of that, as we know that analysts often are too ambitious. Now the discount rate's at 9.5%, there's no dividend, so we don't have to reduce that by anything. We're looking for that 9.5% return year on year to this 2028 value before applying our margin of safety. And that's what we want to see, and if we are able to get that, then the fair value will be above the market price. Share dilution, I've gone for a conservative minus 1.2%. It's basically in line with what they have been doing. You can see they've fallen from 501 million shares and they've been cutting them back pretty gradually all the way to 471, which is right now. So I think every year they've cut back a little bit, so I think -1% isn't too ambitious, and I think that's okay. Now, with margin of safety, as I said, because it is a metric meter and all of these are green, I feel comfortable with a low 10% margin of safety. And for revenue growth, well, I've gone for 11%. This is pretty much in line with what we're seeing the analysts say here. They're going from 19 billion up to 26 billion in 2026. And as you can see, we're doing the same, 19,000 million up to 26 in 2026. So we've put in that 11% revenue growth rate for it to be in line with the analyst expectations. Now the price over sales value, we've used 8 over here, which gives us a price over sales ratio fair value of $334. But price over sales fair value is a bit hard to predict. As you can see, if I show you their price of sales, it was all the way up at 21 and now it's down to 9. And it's not really, it was gradually going up, and that can never go on forever. But for companies that are in a mature stage like Adobe, the price over sales isn't as important. You want to focus more on the price over earnings and the price over operational cash flow. The price over earnings for Adobe, let's have a look at it because it's quite interesting. As you can see, it's sitting at 34 here, and it's actually the lowest it's been since 2013, which is absolutely ridiculous. I wouldn't expect that PE ratio to last that long. Their growth will probably slow down, and with that, the price over earnings ratio usually comes down a bit as well. So I head over here and I looked at the sector median. Now I would expect a slight premium on Adobe, but the median for the sector is coming in around that 2018 mark for the price over earnings. I wanted to go somewhere a little bit closer to that. I've gone for 22 right here. You can see they had that 46 average back when the earnings growth was 30%, but this growth at the early stages was really high. So if you were to look at the growth over recent years, it's probably a little bit lower, around that 20%, 15%, not up at this 30% mark. So based on that, being around 20%, this 46 is basically just over double. So I've gone for similar. We're expecting a 10% earnings growth rate, but I expect the PE to fall a little bit, maybe come in just over double the earnings growth rate, 22. That's what I've put in for this estimate. If you think that maybe we should bring this down a bit, if you think, oh, it's actually probably going to be closer to the sector median at 20, then that would bring our ratio fair value down to 299. So these decisions are up to you. It is important that you take these things into account. If you think there's still going to be a big premium on Adobe, as I say, 34 is the lowest it's been since 2013. You think that's going to stick around and you want to put this at 30, then the fair value becomes 448. So it's all down to what values you put in here. I want to be slightly conservative, but I do think there'll be a little bit of a premium. So I've gone for 22, and you can see that's coming in just above the market price by 2%, with a 2028 average estimated value of 594 when we take in the cash flow growth rate and our price over sales fair value. All three of the fair values averaged out, coming out at that 2028 value of 594, and that would be a 13% return on our investment if it does hit that value in 2028. Now, as I say, I'm looking for 9.5 when we add that additional 10% margin of safety. This obviously makes it a little bit more than just the 9.5, and so that's why it's up at this 13%, even though it's not far off. If we were to bring that down to 0%, then you can see these jump up massively. And if we were to look at the compound annual growth rate from 360 or from 377 instead of 322, then it would be, instead of E25, look at E29, then you can see there's our 9.5% growth rate. But obviously we want to see what the growth rate is from the market price right now. We're not interested in what the growth rate is from our fair values, as that's always going to be in line with the discount rate plus margin of safety. So for me, I think this might be a good buying opportunity. I'm going to update my metric meters. I'm comfortable with these values. At cash flow at 20, it seems reasonable. The sector have 20 here as a sector median, and as I said, people are happy to pay a premium for Adobe. You could just look at the numbers and the growth. It's got such good financials. People are happy to pay these sorts of numbers for it, and it's not been as low as 20. This is the lowest it's been. It's been considerably higher, averaging at 37. So even though I'm expecting these earnings rates to come down, I think the sector median is fair for these values. And as I say, it's only math here. You might want to change some of these, but based on that math, at 10% growth rate for earnings and 12% growth rate for cash flow, looking at a $340 fair value, which I think is actually reasonable. So that's what my fair value is if you want to buy Adobe. Let me know if it's one you're interested in, and yeah, it was good to see you.